Hi, Alissa, and thank you for joining us today. It's good to see you again.
Thank you for having me. It's great to see you.
How are things in Tampa? Blue skies and sunshine?
Yes, it's finally starting to cool off, so Florida is starting to be a livable place again. It's been a hot summer.
Alissa, before we begin, I want to provide a quick overview on where I want to take this discussion. And first, I want to touch on Copernic and examine your investment style. And then I want to move on to uranium and find out exactly how it fits into your investment style. I also want to touch on how you value uranium equities. And then I just want to conclude on where you and your team think the long-term price of uranium is going. So why don't we just begin with an overview of Copernic?
Yeah, absolutely. Kopernik was founded in 2013. We are a global value investment fund. So we invest in all caps, all sectors, all countries, value being the prerequisite. We will never overpay knowingly for a business. So our job is to look across the globe and find businesses, value those businesses, and then wait for the market to be extremely irrational or emotional, and we can take advantage of those opportunities. So today we are finding a lot of value in emerging markets as well as commodities such as uranium.
And what is your AUM?
We are managing about $7 billion now, so we are very happy with that. That's another thing, is that we are capacity constrained. We do not want to become a big investment firm where these small opportunities such as uranium do not move the needle anymore. We're also long-term investors, and then we really pride ourselves on the ability to take on career risk, own these uncomfortable positions to lower the investment risk for our clients. So mining stocks, production company stocks, these are extremely volatile companies, which you can see in the last couple of months. We've fortunately had upside volatility in the uranium companies, but for a very long time we had to be very patient. We've owned uranium mining companies since 2013. For a long time, all they seemed to do was go down. So we're happy to see that the thesis is finally starting to be recognized in the market. But this was a painful investment for many years, and many companies and many firms will not be that patient.
Alissa, you mentioned that you're a value investor and you go where you see value. What sectors do you see value in right now?
There are across a lot of sectors we see a lot of value. However, most of that is in emerging markets. As you know well, that the US markets are extremely expensive. It's very hard to find value in the US. So emerging markets make up close to 40% of our investment fund. Commodities, extraction businesses are also areas that people don't really want to touch. So 45% of our fund is invested in these sorts of production companies. Gold mining is close to 25%. Uranium is 9% of our fund, and then the remainder is in natural gas and oil.
Alissa, that's a great overview of Copernic and your investment philosophy. Now let's discuss how uranium fits into that philosophy. Why are you so bullish on uranium?
So the uranium, we're bullish on it because we believe it's underpriced. Uranium today is around $40 a pound. We believe, and across all commodities, we invest after figuring out what they're worth from an incentive price. Now, the incentive price is the price that incentivizes enough supply to balance future demand. So from our standpoint, based on the cost curve, based on our talks with management teams, the incentive price for uranium is closer to $70 to $90 a pound. Now that range is wide, but that's because the supply curve becomes very steep at the far right of the curve. So from our standpoint, uranium is still underpriced. You're not seeing new mines being built. You're not seeing acquisitions. Management teams tend to be very pro-cyclical. And you're not seeing new supply that was cut during the bear market being brought on yet. So we still think that there's room to run with uranium. On the demand side, it's also very positive. New governments are starting to recognize that uranium is a zero carbon, very low cost, good base load power supply. And so the attitude around nuclear power is improving as well. So we see a lot of nuclear power plants being built in emerging markets. Some of the power plants in developing markets which were supposed to be shut down, are now, you're seeing governments decide that maybe we want to extend these. The cost of just extending the life of a nuclear power plant is much cheaper than buying. So the demand side looks good. Obviously, the bear case to the demand side would be if there was another Fukushima or something that happens. But at this point, those risks are more than priced into both the uranium price as well as the mining companies.
Alissa, you mentioned that your AUM is approximately $7 billion, 9% of that is allocated toward uranium stocks. How many uranium stocks do you own, and are you focused on the large caps, or will you also go down cap?
As I mentioned, we invest in all caps. So we have a couple of production companies. We have a couple companies that just hold uranium, as well as some explorers that are sitting on uranium deposits but haven't yet mined that yet.
And do you have a preference for producers over developers, or developers over explorcos, or?
For us, price is paramount. So we size our positions based on the market cap. We can't have obviously a huge position in the smaller company, but we also size based on the upside that we see, risk adjusted. So from our standpoint, the holding company is less risky than the producing company, which is less risky than the company that is sitting on uranium, but we haven't seen the capital being spent there yet, and there's all sorts of risks that go along with that. So we value all of the pounds the same. We say the holding companies, those pounds have been out of the ground, so that's valued at our incentive price. The production companies have uranium in the ground, which the market is giving a huge discount between pounds above ground and pounds below ground. We think that discount is too large. And then they're discounting even further the explorer companies. So we say all companies, a mining company at least, all those pounds are worth roughly $30 a pound. But we will heavily risk adjust the companies in Kazakhstan or the companies that haven't built a mine. There's so many different risks that can go wrong with a mining company, and so we wait for the market to be extremely inefficient before we invest in a mining company.
Spot uranium has gone from $30 to as high as $50 in the last few weeks. Are you still bullish given this move in the spot price?
Absolutely. We obviously less bullish than we were when uranium was 20. That was just an unbelievable opportunity. Now at 40, we still see upside relative to the incentive price. MacArthur still has not come online. There's still the largest, highest grade mine in the world that is sitting idle. We think that, hopefully we'll see when they bring that back on. That's an indication of getting closer to the incentive price. We still have not seen companies acquire each other, and that is something that you see in the bull markets. There are a lot of uranium pounds that are sitting idle in Africa. Those have not been brought on. So once we start seeing those sorts of actions, then you know that you're getting closer to the incentive price. An example is, and then oftentimes the commodities will overshoot. For example, in the early 2000s, you had uranium go from $20 to $137 a pound. Production will follow. Production did follow. Kazakhstan brought on 10 times the production during that time. And then Fukushima happened. There's too much supply, the price comes down. So the commodity prices will tend to stay below the incentive price for too long, and then they go above the incentive price for too long. Right now, we're still below the incentive price, so we are still excited about uranium.
You own both the Sprott Physical Uranium Trust and also Yellow Cake. Tell us why.
For the very reason that we just talked about, the uranium price is still below the incentive price. That is the long run price that we're using. So once we get closer to that, you will see us trim out of those stocks.
And in terms of the big cap producers, you own both Kazatomprom and also Cameco. Given one is based in Kazakhstan and another one is based in Canada, do you value them differently?
From a theoretical value standpoint, no. Every company that holds uranium gets $30 uranium. That's the cost. That's the amount we think they'll earn over a long term. However, we are talking about Kazakhstan and Canada, and obviously we want a much larger margin of safety before we invest in Kazakhstan than in Canada. Kazatomprom is cheaper than Cameco on a per pound basis, and therefore we do see more upside with Kazatomprom. However, you have to heavily risk adjust for the geopolitical risk. Both of them have fantastic mines, and they both have extremely long reserve lives. Management teams have done very well. So we like both of them. We prefer one geography over another.
Have you or any members of your team done site visits to either one?
Two members of our team have gone up to Cameco's mines. We have not yet visited Kazakhstan. However, that sounds very interesting. We do travel a lot to see a lot of the mining companies that we go to. My favorite trip was going to Mongolia to visit the Oyu Tolgoi mine, the copper mine.
Oh wow, when was that?
That was 2016, I believe. Yeah.
So there's a number of uranium mines shut down due to the low price, with the largest one being Cameco's McArthur River. You already touched on that. And you've mentioned that this notion of the incentive price being where people are incentivized to start producing again. So what price do you think we're going to see an influx of mines coming on and in mines starting up again?
It's an estimate. It's a tough price to be accurate about, but we think anywhere between $70 and $90 a pound. We're not going to argue one way or another. And the reason it's a large range is as I mentioned, that supply curve is pretty much a vertical at the far end. So if you see more demand than you expect, then you're closer to that $90 a pound than the 70.
Alissa, let's wrap it up on where you and your team see the uranium price going. You mentioned that you think the incentive price is somewhere between $70 to $90, but does it get back to its all-time high of $137 a pound?
It very well could. Oftentimes, the prices overshoot the incentive price, so we could see that. However, the solution to high prices is high prices, and we will probably see a lot of production come on, and then prices will come down with more supply. The other thing that is bullish for commodities is the fact that we've had a huge amount of money printing. This reminds us a lot of the 70s, where you had governments financing deficits through printing money, and you had a lot of inflation, and real assets went up a huge amount. Uranium, for example, went up close to 7 times in a matter of 3 years. So that just gives you a sense of the scale that you might see with inflation should that move its way into the real assets. Real assets today versus financial assets are the cheapest we've ever seen. If you look over a 100-year period, they're cheaper than they were in the early 70s before they skyrocketed higher. So there's a very good chance that uranium well overshoots the 70 to 90 range. However, we're not going to price that into our investment thesis.
And I think the other element that's totally different this time than we saw back in 06 and 07 is the fact that the two largest producers in the world, Kazatomprom and Cameco, have become much more prudent and disciplined in their approach, in that they're just not dumping pounds onto the market. They're actually shutting in supply.
Yeah, Cameco shutting down MacArthur was the right thing to do, and we have a lot of conversations with management teams of mining companies saying, why are you selling your resource into an oversupplied market? If what a lot of these mining companies do is they say, oh, well, look at our cash costs, it's less than the price, we're making money. But we say, well, it took you $60 a pound to find that, and you're selling it for $20 or $30 a pound. To us, that is a money losing action, but a lot of people just look at the cash costs and they don't see that. So Cameco did the right thing. It didn't look good from a DCF point of view, and when you're just counting cash, and that is a big problem in the market. Is investors are only looking at current cash flows. They're not looking at the cash flows that would come in 10 years. And when you're dealing with an underpriced good and a scarce good, DCF models don't really capture that value.
One more question before I wrap it up, Alissa, and it has to do with sports. Tampa Bay has some incredible sports franchises. The Tampa Bay Buccaneers won the Super Bowl earlier this year. The Tampa Bay Lightning won the Stanley Cup in 2 consecutive years. What's your preference, football or hockey?
Oh, I'm the worst person to ask that question. I'm unfortunately not a good sports fan, so that's a better question for somebody who pays attention to sports. I inherited some sports teams through marriage, but that's as far as I go.
You're just focused on making money.
That's right. All my attention is on finding investment opportunities. Yes.
Well, Lisa, I want to thank you very much for spending time with us today and sharing your thoughts on uranium and how you value the equities and also where you think the price is going. Once again, thank you.
Thank you so much for having us. Happy to be here.